Hey guys, welcome back to the Jonathan Wells Financial Show. I'm your host, John. This is my show. I want to give you guys an actual breakdown today. We're going to be talking about the death of the 15-year mortgage. Now, before Dave Ramsey comes out and slaps me, I want to give you guys a little preface here. Definitely make your own decision when you're looking at this. Look at the options with your mortgage loan originator. Have them help advise you. But I wanted to give you guys a little breakdown and some helpful tools that I use with my clients when we actually make the decision between a 15-year and a 30-year. Before we get into the video here, I want to let you guys know first, go ahead and smash that like button for me, please. Go ahead and hit a subscribe there while you're at it as well. And then definitely comment as well, because it definitely helps with my channel's exposure. I'm actually going to be posting new content every Tuesday, Thursday, and Saturday, so be prepared for that. A lot of this is going to be financial videos like this. There's going to be some other reactionary videos too. That way you guys kind of get a mix of everything. So first we have to look at what an actual 15-year mortgage is and what an actual 30-year mortgage is. So a 15-year mortgage is going to be a loan that pays off in 15 years, obviously. Typically it's going to carry a lower interest rate, whereas a 30-year may have a slightly higher interest rate and it's going to pay out over 30 years. Your payment's going to be a little bit cheaper because the loan is with a longer duration. So the reason why financial gurus like Dave Ramsey love a 15-year mortgage is because it pays off your home faster. You don't carry out debt for that long, and so you actually carry a smaller interest balance because you're only paying that lower interest rate for 15 years as opposed to paying a higher interest rate for 30 years. Okay, so the first thing we need to look at here before we actually get into the breakdown is, number one, how long is my client going to be in that home, because that's going to determine what type of mortgage we go with. Second thing is, how much are we going to be owing on that mortgage when we leave the property? Third thing is, how much retirement savings is my client going to have? And the fourth thing is, how much interest are they going to pay? So I'm actually going to go and hop into a little demonstration with you guys.
Hey everyone, okay, cool. So now we're going to hop into the actual numbers here so I can walk you guys through it. Okay, so the first thing we're going to be looking at is 15 versus 30-year mortgage. So you've got 20% down on a $300,000 purchase, so mortgage for $240,000. And you've got total interest paid is going to be $69,000 versus $172,000. So I'm actually going to pull this up for you guys here on my other screen and walk you guys through exactly what they're talking about. Okay, so we got a property here for $300,000. We're going to put in our property tax rate for Indiana. Now, again, I'm going to be looking at just the interest portion of this. Your taxes, your home insurance is going to be the same no matter what loan you go with. And we're also not going to count the property's appreciation, because that's just another added factor in here, and it's really going to be the same no matter what mortgage you get, because your property is still going to go up by the same amount per year. So we have our 15-year mortgage, conventional 3.5%, versus 30-year mortgage, conventional fixed at 4%. And this is the example that they gave in here as well. So I just pulled that in. So you've got your monthly principal and interest, $1,716 versus $1,146. Is that about right? Yep, that's the exact same. Cool. Seriously, guys, I'm trying to film a video. Seriously? Okay, cool. So we are 1716 versus 1146, and that matches up with what they have here. So the most important thing you guys need to realize is, one, what can you be saving in your retirement account? And two, how long you're actually going to live in the property, because nobody lives in their home for 30 years. The average first-time home buyer is going to be in their home for 5 to 7 years. So let's go ahead and slide our dial back to, let's say, 7 years. Now you're saving $570 a month in your actual mortgage payment. And as you can see, your home insurance and your taxes are the same no matter which loan you go with. And if you look here too, the lowest cost over 7 years is going to be the 15-year mortgage, because you're paying significantly less interest in that duration of time. However, you are still paying $570 more per month. So let's see what we could get with that money in the market. We're going to add in a periodic payment of $570 every month. Assumed rate is 7%, and a length to evaluate is going to be 7 years. So in this scenario here, shows that you'll have $61,487. Your interest gained of that is going to be about $13,607, and you have contributed $47,880. And if you look at the interest portions over here, you've got $48,000 in interest with the 15-year mortgage, and you've got $63,000 with the 30-year mortgage. You also have a balance of $143,000 left on the 15-year mortgage, whereas you have a balance of $206,000 left on the 30-year mortgage. So what I'll do is break down on the screen the actual total differences of everything here at the 7-year option, see which one's positive and by how much. Okay, cool. Now that we've seen that, our next home buyer is most likely going to be in their mortgage for about 10 years. So we slide our number over to 10 years. We take a look, it's the same stuff. So you're still paying $570 more per month. This is the total interest paid, $60,199. Total interest paid here on your 30-year mortgage, slightly higher. As you can see, the 15 years is still going to be the lower option. However, let's just slide this to 10 years and see what we have. We've got almost $100,000 in additional retirement savings, and $30,000 of that has been saved in just interest. So at this point here, you're actually slightly higher in interest gained by putting money into the market against the interest saved from taking out the 15-year mortgage. Now, let's say somebody stays in here for 30 years for the whole duration of the mortgage, and they decide to invest the $570 for the full 30 years. Now, this is what they have here. We're a balance of $671,000, and they've gained $466,000 in interest by only contributing $205,000. Whereas if they stopped paying the 15-year mortgage at year 15 and they invested the entire amount here of $1716. Okay, so let's assume that person that has the 15-year mortgage pays off their mortgage in 15 years and then invests the principal and interest difference into their retirement. So they're going to have a periodic payment of $1716 a month at an average rate of 7% returns for 15 years. Boom. Their ending balance here is $537,503. They've gained in interest $228,623, and they've contributed $308,880. So as you can see here, it's actually a lower return in interest, and it's an actual lower ending balance when you choose to not leverage your money. Actually, a lower investment balance and a lower return when you choose not to invest your money, because after this, everyone will be able to invest the same amount going forward, because that's going to be the 30-year. That's going to be the 30-year mark in which both mortgages are paid off, and you can invest whatever you need to invest during that time. And that will break down everything here so you guys can see the difference between the two and the actual net difference. But I wanted to let you guys know about this, especially when you're in your 20s till your late 40s. I really push moving as much money as you can into your retirement account and building up that nest egg, because the more money you put in there, the quicker your compounding interest is going to work for you and actually grow that account. Another thing too that I didn't mention, a reason why I like the 30-year over the 15 is in case something happens, you're actually able to take the money you're investing and you can go pay more expenses, or if your income gets cut, you're not locked into a 15-year mortgage. So if something happens, you don't have to pay that mortgage off in 15 years. You can use that money for something else if you need to. Another thing as well, if you're looking at purchasing investment properties, second homes for Airbnbs or stuff like that, your monthly qualified income is going to be able to be used more with a 30-year mortgage than a 15-year mortgage, because you're locking that money up for 15 years every single paycheck. So guys, I'm going to go back over to my chair over here, and please make sure you drop a like and a comment, and go ahead and subscribe to us while you're here as well.
So now that you guys saw those breakdowns, let me know what you think you would do with a 15 versus a 30-year mortgage. You really can do whatever you want, but I just want to let you guys know that you don't have to take out a 15-year mortgage. You can still take out a 30 and plan your retirement accordingly, and still make up for the interest that you're going to be paying. Now, again, I did want to mention here as well, this is a very apples-to-apples comparison with a $300,000 purchase with 20% down. The next video I'm going to show you guys is going to be a case study with an actual mock client who's going to be purchasing a home with a salary of $70,000 a year. And we're going to see what options he has available to him and see how it would work out if it was you guys in that scenario. So thank you so much for your time today. I really appreciate it. Have a great one. I'll talk to you soon.